Hello. Hello, everyone. Am I audible?
Yes.
Hey, hi. Good morning, everyone. My name is Mridula Bihani, and I'm act like a director finance and accounting at Crow UAE, where I oversees accounting and the outsourcing services. Um, my personal introduction is I'm a qualified chartered accountant with approximately 16 years of extensive experience in the field of finance and accounts. And with my colleague, my colleague Anand Panchal is here, who's having more than 6 years of experience in UAE. So by the title of today's webinar, it's more evident that we are going to discuss about a more complex term that is basically the intersection between the accounting and the corporate tax. So but today we'll discuss the reason why accounting hold a significant importance in the UAE corporate tax environment and how it plays a pivotal role to shape the landscape of the financials for all the organization as per the corporate tax. So without wasting time, let's begin our explorations. So today's main agenda of this presentation is, or the webinar is that significance of IFRS standards, chart of accounts as per the corporate tax rules, importance of accounting and accounting health checkup in lieu of the corporate tax. And the last one is a training session that we'll discuss in the last slide. And we'll more explain about that what is the planning for the training sessions and the courses that we are going to offer. So a quick note on the ministerial decision of 114 of corporate tax, that every taxable person should has to prepare their financial statement that is not limited to the statement of income, statement of comprehensive income, balance sheet, statement of change in equity, or the cash flow statement. Rather, every taxable person has to apply their financial statement or has to prepare their financial statement as per the applicable IFRS, that is International Financial Reporting Standards. So there are some relief that has been given to the small and medium enterprises by the government. So like the taxable person whose revenue is less than 50 million, so they can opt for a IFRS for SMEs. There are some small relief they have given for the IFRS, not the complete IFRS they have to follow. They have to follow, or they have some limitations, or they have some liberty in terms of the IFRS. And if I'm talking about the consolidation of financial statement of a tax group, so every financial statement or the standalone financial statement should be prepared as per the applicable standard. So the parent company and the subsidiary companies, they can eliminate the transaction between during the consolidation, but they have to prepare that standalone financial statement as per the standard that is applicable in UAE. So why accounting is required as per the IFRS? So it's like today's main agenda of this webinar is why accounting is required as per the IFRS or as per in lieu of the corporate tax. So one is like uniform reporting. So by word uniform, it is clear that IFRS provide a consistent and standardized framework for the financial reporting. If accounting is done as per the applicable IFRS, it will ensure that will report financial information in a uniform manner, and that will help the tax authorities to assess the financial statement or assess the tax liabilities according to that. So accurate tax calculation, that is a very important thing that if when the corporate tax is in force in UAE, so that accurate tax calculation is the most important word. So in UAE, like many other countries, so every business has to calculate their taxable income for the corporate tax, to calculate the corporate tax liabilities. So therefore, using IFRS compliant accounting ensures that companies' financial statements are prepared in a manner that is aligned with the tax regulation. In other words, I can say that if I'm talking about the corporate tax and the IFRS, so accounting should be done as the basis of the proper chart of account should follow, proper disclosure should follow as per the standard. If the accounting is correct as per the standard or as per in lieu of the corporate tax, then that will help us to arrive the accurate taxable profit. So third one is financial statement accuracy and the transparency. So IFRS emphasize transparency and require comprehensive disclosure in the financial statement. So transparency can assist tax authorities in understanding the company's financial position and basis for its reported taxable income. So as I can say that the financial statement are accurate or the transparent, that will help the tax authorities to assess the financial condition of that particular company, and that will help us to that will help the authority to check the whether the tax calculation has been done properly or not. So third one is the fourth one is legal and regulatory requirement. So during the depending upon the legal structure, or I can say that based on the industry, so there may be a legal and regulatory requirement in the UAE that mandate the use of IFRS and specific set of standard they have to follow while preparing the financial statement, or which may extend to the tax reporting as well, which is required for the tax reporting as well. So next point is increases investors' confidence. So investor is a very important terms in terms of the business. So accounting and reporting based on the IFRS gives the uniformity or gives or provide the transparent, consistent, and internationally recognized financial information. So basically, if the all the companies or either it's like if I'm talking about the parents and subsidiary, so parent company is outside the UAE and the subsidiary is inside the UAE. If they both follow the same set of the standards, that's easy to compare or easy to assess the investor to the financial position of that particular company, and that will help us on also on the consolidation. Last but not the least is reducing risk. So transparency in the financial reporting ensure that investor and stakeholder have access to standardized and trustworthy information, making it easier to access a company's financial health and the associated risk. So in a very simple or layman language, if I can say that accurate accounting is a pillar to arrive the accurate taxable profit. If the accounting is correct as per the chart of a chart of accounts, what we follow as per the IFRS, that is aligned with the corporate tax. So it will be easy to calculate, or it will help us to calculate the accurate taxable profit, because that accounting profit is the book profit is the base to calculate the taxable profit. So I hope that everyone is clear that accounting is like most important thing that we need to do in UAE as per the standard and in lieu of the corporate tax. So there are multiple IFRS that we need to follow, but that webinar is only for an hour, and I cannot cover all the IFRS. But there are some IFRS which is important in terms of the all industries that they have to follow. They have to disclose the financial information as per the applicable IFRS. So IFRS 15 that basically deals about the revenue recognitions. If I'm talking about the revenue recognitions, so revenue recognition is something that when revenue should be recognized in our books. So that is also as per the industry specific that I'll discuss more about in the later that the PPTs. So there are 5 steps of revenue recognitions that every company has to follow, and the 5 steps should follow together, not like one step follow, then it's all like combined 5 steps should follow. So first one is identify the contract. So identify the contract. Contract means an agreement with the customer. It's like a implied or a formal agreement where the goods and services will be provided in exchange in lieu of the consideration. Second is identifying separate performance obligation. So performance obligation is the promise that we are going to do with our customer. At this point of time, we are going to provide you the service, or at this point of time, we are going to sell you the service, we transfer the ownership to you. So that's a performance obligation is nothing but it's a like a promise that we are going to do with our customer. So determine the transaction price. So at what price we are going to transfer our goods, or we are delivering services to the customer. That is basically that the transaction price that we are agreeing on. Our fourth step is allocate the transfer price to the performance obligation. So if suppose I have entered into a contract with multiple performance obligation in one contract, then we have to allocate the transfer price on to the performance obligation based on the standalone price that I'll define you in later slides. So recognize revenue when the performance obligations are satisfied. If all the 4 conditions are satisfied, that we are going to recognize our revenue when the performance obligations are satisfied. So this is the 5 steps of revenue recognitions that every company has to follow while recognize revenue in their book. So there are some industry specific that IFRS 5, all 5 steps we have discussed in the previous slides. Now I'm going to give you some example on an industry specific at what time different industries should recognize their revenue. So if I'm talking about the software and telecommunication industry, so basically that industry enter into a contract for a longer period of time, either a year or 2 years like that. So that revenue should be recognized during over a period of that particular time for which we have entered into a contract. So like construction industry. So that's basically for the construction industry, we recognize revenue on the percentage of completion of method. If suppose the 80% of the that construction has been completed, so we will recognize only to the extent of 80%. So like uh, retail and pharmaceutical industries. So they basically deals in the point that delivering of goods. So delivering of products or at point of sales, we recognize the revenue. Once the transfer of ownership of that particular good has been transferred to the customer, at that time we recognize our revenue. Like that healthcare and hospitality that deals with the services. So that revenue should be recognized for that particular industries on the basis of services provided. When the services are provided, at that time we are recognized on revenue in our books. So a simple, very simple example of IFRS 15. So I hope that after this example, you are clear how that revenue should be recognized and how this 5 steps should follow. So first, let's suppose if I am a software company and I am into contract with a customer to provide a software license services for a year at the dollar of 1200. So my first step, that is identify the contract. That first step that we have followed here. The second step was performance obligation. So performance obligation is basically the promise. So that promise that I have done with my customer to provide the software license for an year. So here the second step has also followed. So third one is the transaction price, because we have entered into an agreement that we will provide the software services at dollar 1200. So my agreed transfer price, transaction price is dollar 1200. So fourth one is allocation of transaction price based on the performance obligation. So here only the one performance obligation is there, that is the providing of software license. So here my this step has been followed. So last one is revenue recognitions of the revenue, because I have entered into a contract for a year. So that revenue should be recognized over a period of 1 year. So every month we will going to recognize our revenue or recognize revenue in our book as a dollar 1200 for 12 months divided by 12. That is dollar 100 for per month. So I hope that this example gives you a brief about how to recognize revenue in our books. So I have taken one more complex exam because I said that IFRS 15 is the most complicated and most important IFRS that every company has to follow. So here again, the software, I'm a software company and I am providing like different kind of services to my contract, to my customer. So I have entered into a contract that I'll provide you the software license for 1 year at $60K. Ongoing and the training sessions is $20K, and ongoing technical support for a year for $30K as a standalone price. And overall, if I'll enter into a contract, the entire services I'll provide you at $100K. So that's the contract that I have entered. So that identification of the contract has been done here. The second is performance obligation. So performance obligation is a promise that I have given to my customer on a contract that I'll provide you the software license for a year, training sessions, and the ongoing technical support for 1 year. So that is the performance obligation that I have done with my customer. That is the promises I have done with my customer. So third one is the transaction price. So transaction price for overall all the services that I have committed at $100K. So here I'll show you how to allocate your transaction price in a different performance obligation, because first example only the one performance obligation was there. So it was very simple. But here three performance obligation that I have committed to my customer, and my total transaction price for that particular that for all the three contract is for $100K. So how to allocate that? So we will allocate the performance obligation based on the individual standalone price of that performance obligation. The standalone price for the services are as follows. The software license for 1 year is $60K. On-site training session is $20K. And ongoing technical support for 1 year is for $30K. If I'll go for the standalone price, it comes to $110K. So allocation of transaction price based on the relative standalone selling price is as follows, as below. So software license, that $60K is the standalone price. Overall standalone price is like $110K. And the total contract price or total transaction price is $100K. So I have allocate my 60K on a portion on the basis of the 100K. So it comes to $54,545. On-site training session, if I'll speak about, so I have again allocated the same on the basis of the standalone price, that is $18,182. And ongoing technical support for 1 year for $30K was the standalone price. So I have allocated into the transaction price, that comes to $27,273. So now the recognition of revenue, the fourth that step also we have followed the allocation of the transaction price based on the performance obligation standalone prices. So software license for 1 year. So now how to recognize revenue, because there are three performance obligations. So one is that software license for 1 year. So software license is for 1 year. So we are going to recognize our revenue over a period of 1 year. The total price was 54,545 for the entire 12 months. So I have converted the 12 months into the per month, that the revenue should be recognized at $4545 per month. So on-site training session again. So because on-site training session is a one-time performance obligation that we have entered for. So once the training session is completed, we will recognize the entire revenue of $18,182K in our book. So ongoing technical support for 1 year. That is again for the 1 year that I have entered into a contract. So I'll convert the overall revenue into a per month basis and will recognize revenue over a period of 12 months as $2273 per month. So I hope after this two example, you are more clear on the IFRS 15, that is the revenue recognition. When and how should the revenue should be recognized in our book. If you have any questions, you can write down in the chat box. We will discuss later on this after the completion of all the slides. So next important IFRS is IFRS 9, that is financial instrument. So financial instrument is basically, the IFRS 9 specifies how entity should measure or classify the financial instrument. If I'm talking about the financial instrument, there are two main instruments are there. That is, one is financial assets and financial liabilities. So by financial asset, if I can say, that can be measured or classify, or that can be measured or recognized in our book as per the different methods. The one is the amortized cost and second is a fair value. If I'm talking about the fair value, there are different assets that should be valued as a fair value through P&L account and fair value through other comprehensive income. Financial liabilities is simply measured at a amortized cost or a fair value through P&L account. So different ways to recognize the financial assets. So if I'm talking about the amortized cost, the holding asset in order to generate the contractual cash flow. If I'm holding any asset to that with the intention to generate a cash flow after over a period of time, over a life of the period of that in particular instrument. So that is basically that holding asset to generate the contractual cash flow, which that financial asset should be recognized or amortized at cost basis. So some of the example are trade payable and loan. Trade payable and loan is for the short tenure of time, so that will be amortized at a historical cost only. Bonds held for the maturity, that is basically we need to measure at an amortized cost. So second step is like when to measure the financial asset as a financial fair value through other comprehensive income. So when the intention of holding that asset is for the selling or to generate a cash flow. Matlab both the conditions should fulfill. So we are going to hold some asset or financial asset in our book to generate the cash and held for sale. So that financial asset should be recognized in our book or measured in our book through a fair value through other comprehensive income. So some of the examples are equity or stocks. The third one is other business model. If both the conditions are not satisfied, then we have to measure the financial asset at fair value through P&L account. So basically neither held for the contractual cash flow nor held for the sale. So some of the example are investment in equity instrument. The financial IFRS 9 is a very vast that discuss about the impairment, derecognitions and all. But here I cover only this much, but the next webinar I'll going to deeply explain you about the IFRS 9 with the examples. So there are certain implications if you are not following the requirement of IFRS 9. So financial risk management. IFRS 9 defines how to measure or recognize the expected credit loss on the financial assets. Non-compliance may result in inadequate provision of the credit loss, which may lead to understand the financial risk and the potential financial distress. So basically, if you are not going to access or make the provision of the credit loss on the financial statement, this may lead to the understatement of the profit or understated financial risk. Second is a regulatory and legal consequences. So after the CT in UAE, after the corporate tax in UAE, there are regulatory requirements that mandate to use the IFRS in financial reporting. Failure to comply, if you are not going to report that, that is basically the failure of comply to that regulations, and that may be that can result into legal and regulatory actions like fine, penalties, and other legal disputes. So means we have to follow IFRS, we have to disclose our books, so we have to recognize the financial instrument in our books as per the financial standard. Risk of overstated profit. Again, if you are not going to make the provision or adequate provision for the credit losses, that will impact our, increase our profit. That is not going to give you the correct profit. That will show us an overstated profit. So that will going to appear higher than it should be. The profit should be going to appear higher than it should be. So failing to reflect the actual credit risk associated with those assets. Inaccurate asset valuation. So non-compliance of IFRS 9 may lead to interpretation of the value of company's assets in the financial statement. So if you are not going to correctly value our asset in our financial statement, that will give a misinterpretation, or that will not give us the correct disclosure in our financial statement, which may lead to the misleading financial reporting, which can lose the trust of the shareholder and result in regulatory, legal, and the financial consequences. So that is basically the sum of the points that will implicate if we are not going to adhere to the requirement of IFRS 9 that deals in the measurement and recognitions of financial assets in our financial statement. Then IFRS 7. IFRS 7 deals with the disclosure of financial instrument. So if I'm talking about the disclosure of financial statement, so they are like, we have to disclose in our books as a fair value or amortized cost, whatever be the cost method that we are going to apply as per the IFRS 9. Categorization of the financial instrument, risk disclosure should be there, quantitative and qualitative disclosure should be there. So in simple language, if I can say that IFRS 7 require disclosure of information about the significance of financial instrument of an entity and the nature and extent of risk arising from those financial statements, both in quantitative and a qualitative disclosure. So if I'll say the fair value disclosure, as we have already discussed, that disclosure, that valuation or the recognition should be done as per the IFRS 9. So we need to see whether we are, so the entities must provide disclosure about the fair value of financial instrument, either individually or in group based on the nature of the instrument. Categorization of financial instrument. So there should be a proper categorization of the financial instrument when we are going to disclose in our financial statement. So that's the financial assets, financial liabilities, and equity disclosures. Third is risk disclosure. So as the IFRS 9 says that we need to disclose our financial statement with the nature and extent of risk. Nature and extent of risk, what kind of risk? It's a credit risk, liquidity risk, and the market risk that should be disclosed in our financial statement. So if I'm talking about the credit risk is the risk when one party of the financial instrument will cause loss due to the other party by failing the pay obligation. Means if suppose I am entered into a contract with some party and I am getting lost because that the second party of the contract is not paying their obligations on time. Liquidity risk is the risk when entities have difficulty in paying in the financial liabilities because we have a like liquidity issues in our business. So that also we need to disclose. And the market risk is the basically the fair value or the cash flow of the financial instrument which fluctuate due to the market rates or market prices. So that basically that we need to disclose our financial instrument at a fair value. That disclosure should be the categorization of financial instrument should be there, and the risk of the nature and extent of the risk also should be disclosed in the financial statement. And the last one is a quantitative and qualitative disclosure. So IFRS 7 mandates that we need to disclose the quantitative and qualitative. So quantitative means is basically information that will include the carrying amount, the fair value, the term of maturity, contractual maturities. And qualitative information, basically the management objective and strategies, and that also will cover that will strategy and the information about the risk, that is credit risk, liquidity risk, and the market risk. But the risk we need to show the nature and extent of the risk, and also the strategies how to overcome that risk also should be disclosed in the IFRS 7. So the one is like IAS 21, that IFRS is there, but along with that IFRS, we need to follow some IAS also, that is the International Accounting Standards. So IAS 21 deals with the effect of change in foreign currency rates. IAS 21 deals with the effect of change in foreign currency rate and is applicable to the companies where the multiple currency involved in the business. IAS 20 help how to translate the financial statement into the presentation currency. So there are some impact if you are not following the IAS 21 in the financial statement. So inaccurate financial statement. Not following the IAS 21 can result in the preparation of inaccurate financial statement, especially for the companies with significant foreign currency transaction. If we have a multiple currency transaction in a one company, and if we are not going to just prepare the financial statement as per the effect of change in that foreign currency, that will not give us the accurate financial statement. Second one is misleading financial ratio. If I'm talking about that, if we are not following the IAS 21 and we have not taken the effect of change in foreign currency rate in our books, so that will give us the inaccurate financial statement. And on the basis of inaccurate financial statement, if I'm going to calculate my financial ratios, that will also mislead. So currency gain and losses, exchange gain and losses. If we have not taken the currency impact in our in our financial statement, that will again give us the not the correct income statement. Maybe it will it will overstate the profit or it will understate the profit. So that also again affect the company's reported profitability. Last one is non-compliance penalties. So as I already discussed earlier also, because after the corporate tax is into force in UAE, every company has to prepare their financial as per the IFRS, and that is the mandatory requirement as per the regulatories. So if you are not going to follow or not going to follow the standard provided by the regulatories, and if you're not going to align with the regulatories requirement, that the company has to face the penalties, fine, and other enforcement actions. So one most important that IAS is IAS 12, that is basically that deals with the accounting for income tax. So accounting for income tax deals with the income tax. If I'm talking about, there are two taxes. One is the current tax and one is the deferred tax. So IAS 12 provide guidance on the recognitions, measurement, presentation, and disclosure of the income tax. So that is the current tax and the deferred tax. And after the corporate tax in the context of UAE, IAS 12 is relevant for the disclosure in the financial statement. So there are some rules we need to follow while calculating or while measuring or while disclosing the deferred tax on the current tax in our book. So one is recognition of current tax and the deferred tax. So current tax assets and liabilities are recognized on the tax payable or the refundable in the current reporting period. So whatever tax or whatever the book profit or the taxable profit I'm generating during that current period, the tax on that is basically defined the current taxes. If I'm talking about the deferred, by word, it means deferred. So deferred tax assets and liabilities are recognized for temporary difference between the accounting profit and the book profit in a very simple layman language. Second is deferred tax accounting. So how to calculate the deferred tax. So the deferred tax assets, it's likely deferred tax assets are recognized when it is likely that future taxable income will be available to utilize them, or while deferred tax liabilities arises from temporary difference that will result in future taxable amount and accounted in books of accounts. So if third one is measurement of deferred tax. So deferred tax asset is measured at like difference in the difference in the temporary difference between the book profit and the taxable profit multiplied by the tax rate applicable in UAE. So if my tax profit is more than my book profit, then the deferred tax asset arises, and if the vice versa, then deferred tax liabilities arises. So recognitions of tax losses. IAS 12 provide guidance on the recognitions of deferred tax assets related to the tax losses. A deferred tax is recognized for the deductible for unused tax losses and unused tax credit to the extent that it is probable that future taxable income will be there to set off that tax losses. So fifth one is presentation. How to present the deferred tax assets and liabilities in our financial statement. So as the law say, we can we can represent as a net of deferred tax assets if the deferred tax asset is more than deferred tax liabilities, or if a deferred tax liability is more than a deferred tax asset, then we need to show as a deferred tax liability. In any case, we need to show as a net of deferred tax or the deferred tax liabilities, deferred tax assets or the deferred tax liabilities. So change in tax rate. Change in tax rate means address the accounting treatment for change in tax rate, including the impact of deferred tax assets and liabilities. Last one is uncertainty in income tax. So standard provides the guidance on how to account for uncertain tax position. Entities are required to make provision when it is uncertain whether certain tax position will be accepted by the tax authorities. So I know it's a bit that theoretical portion that I have covered here, but I have given some good example in the next slide that I'm going to explain you. So here are two examples that I have given when we have to calculate the deferred tax assets and deferred tax liabilities in lieu of the corporate tax. So due to capping of 12 million of allowable interest expenses, as per CT will lead to arise deferred tax asset, and how? So there's a simple example that I have given. Suppose if I'm my company has having a EBIT of 50 million. EBIT means earning before interest and taxes. And my interest expenses as per the books is 15 million. So my net book profit is 50 million minus 15 million, that is 35 million. But due to the corporate tax law, we can take only the 12 maximum of 12 million of interest as a allowable expenditure while to calculate the taxable profit. So difference in the 15 million, that is as per the book we can claim, and the 12 million capping of the corporate tax as an interest expenses, the 3 million I have added back to arrive the taxable profit. So my new taxable profit is 38 million. So what is the deferred tax asset? Deferred tax asset is the difference between the taxable profit and the book profit multiplied by the tax rate applicable in the as per the corporate tax. So my deferred tax asset here, we are arising the deferred tax profit because deferred tax asset because my taxable profit is more than the book profit because I'm going to pay tax more than that we are going to settling down in the next year. So that is the asset that we are creating here that we are going to utilize in the next period. So the 38 million of taxable profit minus net book profit is 35 million. The 3 million is the temporary difference multiplied by the 9% of the rate that is applicable for the corporate tax. So my deferred tax asset in my book is 0.27 million. So second example here again in the for the corporate tax purposes, carry forward of the tax losses. So as per CT law, that is a corporate tax law, we can adjust the 75% of the prior period losses with the current profit. So here, one more example that I have given, my company profit is like EBIT, if I can say that earning before interest and taxes 50 million. My interest expenses here are 10 million. So my net book profit is 40 million, but I have a loss of a prior period of 15 million. So while doing the book profit, I can utilize the 100% of the loss of the prior period. So that 15 million I have deducted. So my net book profit here is 25 million. But as per the corporate tax, I can set off only 75% of the prior period losses from our for the corporate tax purpose. So that 25% of the losses will be disallowed as per the corporate tax law. So 25% of the 15 million, that is 3.75, is disallowed, that I'm going to add back to my book profit to arrive the taxable profit. So my taxable profit after adding back this is 28.75 million. So here again, the deferred tax asset arises because my taxable profit is more than my book profit. So that 28.75 minus the 25 million, that is 3.75 multiplied by the 9% of the rate which is applicable for the corporate tax. So here also the deferred tax assets arise and that we need to disclose in our books of accounts and in our financial as a deferred tax asset. So hope with these two example, you're clear about the income tax that IAS 12. That is a bit complicated subject here in UAE. So how to recognize our deferred tax or the current. Current taxes are very simple now because we have a like first year and the current tax, whatever is current tax is there for a current period of taxable profit, that we are going to show as a current tax. But the deferred tax, yeah, we need to show some more examples are there here, but I have covered two most important, that is applicable as per the corporate tax law also. So next slide is basically the expenditure should align with the chart of accounts. So my colleague Anand is going to take forward this. So over to you, Anand. Thank you.
Hello. Hello, everyone. Very good morning to everyone. My name is Anand Panchal and I'm presenting the next two slides. But before that, let me thank to Mridula. It was a great explanation on the importance of IFRS in accounting. The next two slides, which covers or focus mostly on the expenditure that are allowable and disallowable as per the corporate tax law. So which means that there are certain expenses on which the company have to pay taxes. So it is very important for every accountant, finance manager, or the supervisor at the time of closure of books of account, either on a monthly, quarterly, or the yearly basis. They need to consider certain expenses on which they have to keep a separate or park it under the separate ledger to have an accurate taxable profit. So the first slides, it contains that expenditure should align with the chart of accounts. So what I meant to say that on 1st of January 2024, which is the applicability of the corporate tax law for most of the companies, they should restructure their chart of accounts to get aligned with the corporate tax laws. So these particular slides contain two articles. First is Article 28, which says the deductible expenditure, and the other is Article 33, which says the non-deductible expenditure. So what does the Article 28 says? It says that expenditure incurred wholly and exclusively for the purpose of the taxable person's business that is not capital in nature shall be deductible in the tax period in which it is incurred, subject to the provision of this degree law. If I break down this particular sentence into different part, then we have a very important term or the word over here. So over here there is a called incurred. So what does that mean? In accounting, incur refers to the financial obligation or expense that is already created but may or may not be paid and for accounted in the company's financial records. That means that the liability is already established, but the payment may or may not be paid at that particular point of time. The second important word is the wholly and exclusively. So wholly refers to the quantum of the expenditure and the amount of the money spent, and exclusively refers to the motive or object behind the expenditure. And this is very much important. The purpose of the taxable person business means what are the expenses that we have made that has to be directly attributable to the activities mentioned in the company's trade license and that are not capital in nature, which means there has to be a P&L item or the revenue in nature, and that particular expense incurred in the tax period. Tax period means the 1st of January 2024 to 31st of December 2024, which is applicable to most of the clients. And the second point is for the purpose of calculating the taxable income for a tax period, no deduction is allowed for the following, which means that below are the points on which the company cannot claim the expenses. The first is expenditure not incurred for the purpose. Mridula, can you please move on to the previous slides? Hello, Mridula. Yeah, thanks. Uh, So the first point is expenditure not incurred for the purpose of taxable person's business, which means the expenses that are incurred are not directly attributable or identifiable to the activities mentioned in the company trade license, or we can say which are the personal expense as well. Second, expenditure incurred in deriving exempt income, which means that if the income itself is exempt, then the expenditure incurred in deriving exempt income is not allowable. Third, losses not connected with the taxable person business. And the last is such other expenditure as may be specified in a decision issued by the cabinet at the suggestion of the minister. The third point is that if there is a common expenditure which is incurred for the multiple purpose, then in that case, first we have to identify is there any expense incurred that is directly identifiable and attributable to the taxable income. And the second, if those expenses are not identifiable, then the appropriate proportion method should apply, and that has to be scientifically verifiable and explainable. So the Article 28 covers the deductible expenditure, and now we can move on to the Article 33, that is non-deductible expenditure, which means that the company have to add back those transactions. There are some certain limitation and condition, and they have to pay tax on such expenditure. So below are 8 points. Let let me cover first donation, grant, and gift. So when a company donate or grant or gift to a certain charitable trust or foundation or any entity, such expenses are disallowable and the company have to pay tax. But there is an exception to the qualifying public benefit entity. If so, the FTA publish a list of entities to which if the company donate, grant or gift, then such expenses are allowable. So before donating or grant any or gift any to any entity, just make sure that you provide such donation or grant and gift to the qualifying public benefit entity. Second is fines and penalties. So these fines and penalties are not deductible expenditure. For example, if a company pays late payment VAT, then such penalties are disallowable. There is an exception. Exception is a compensation for damage or breach of contract. If a company made a breach of contract with a supplier or customer, then such fines and penalties are allowable expenditure so that the company do not have to pay tax on them. The third is bribes or other illicit payment. So whenever the company makes any bribes to any persons or individual, that is disallowable, and other illicit payment, that are the expenses which are forbidden by the laws, which are yet to be published by the government. The fourth is dividend, profit distribution, or benefit to the owner, subject to certain condition. Those are non-deductible expense. Fifth is drawing by the taxable natural persons or partners in unincorporated partnership. This also is non-deductible expenditure, subject to certain conditions. Sixth is corporate tax itself. So the corporate tax itself is not deductible. The seventh is recoverable input VAT. So those input VAT which are recoverable in nature and somehow in some case we have expense it out in the P&L, then such recoverable input weight are non-deductible in nature. The last one is foreign tax. So the foreign tax is disallowed, but we can get the foreign tax credit as per the DTAA. So this particular slides covers the Article 28 and Article 33. So the deductible expenditure and non-deductible expenditure. Can we move on to the next slide, please, Mridula? Now the Article 32. So Article 32 mentions the entertainment expenditure. So these also the deductible expenditure, but subject to certain limitations. It is not 100% allowable. So the entertainment expenditure says the taxable person is allowed to deduct 50% of the entertainment, amusement, recreation activities incurred in the taxable period for the purpose of benefiting the taxable person's customer, shareholder, suppliers, and other business partner, including but not limited to meals, accommodation, transportation, admission fees, facilities and equipment used for EAR, that is entertainment, amusement and recreation, which means that if a company provides to their customers, shareholders, suppliers, and other business partner in terms of meals, accommodation, transportation, then such expenses are allowed only 50%. The rest 50% are disallowed. So, say for example, if there is a webinar or maybe the web conference, conducted in UAE, there are other business partner coming from the different countries or the shareholder or the supplier. They participate in the webinar. So the service is provided from company to the shareholder or other business partner in terms of their meals or their accommodation or their transportation or their admission fees, etc., etc. These all expenses are disallowed to 50% and the rest 50% are allowable. And if the same expenses or the same transaction or the same perquisite, if you provide to the staff, then those are 100% allowable. So the purpose of covering these two particular slides is that every company has to review their chart of accounts not for 2024 but for 2023 as well, and make changes accordingly as per the corporate tax laws, so that on the 1st of January 2024 the opening balance comes in a correct or accurate manner, so that we can have a comparative statement for 2024 and 2023 as well. So thanks a lot uh, for this session, and now over to Mridula. She will cover the next two slides. Thank you.
Yeah, thank you so much, Anand, because as we know that proper accounting or proper booking of expenses is the core or is the pillar to arrive the correct taxable profit. So thank you for your insight on the same. So next topic of this agenda is benefit of regular accounting health checkup. So as we discussed that proper accounting is required, so what is the benefit for regular accounting health checkup? So accounting health checkup, if I can say, that means a financial and accounting review on a transaction level, and which plays a crucial role in companies helping the UAE to manage their corporate tax more effectively. So there are some points that I tried to cover here for the benefit purpose. So one is identifying error and inaccuracy. So accounting health checkup involves the thorough examination of financial records, transactions, and the control process. By comparing data with established standards and the policies, discrepancies and inaccuracy can be easily identified and rectified at the point of the transactions, and that will help us to ensure the integrity of the financial reporting. So that is the one benefit. Second, ensuring compliances. So thorough assessment of financial records and transactions and the reporting practices to verify whether the financial statement is prepared as per the standard or not. So, the non-compliance or a deviation or non-compliance issues are identified and corrected to ensure the consistent financial reporting in accordance with the IFRS. That is the standard, globally standard accounting standards. Third one is the tax planning. So review transaction at a transaction level, ensure the strict adherence to the IFRS guidelines. So suppose if I'm doing my transactions on a IFRS basis and at the applicable IFRS, which prevent the omissions and the errors. So the process of guaranteeing accurate accounting profit by maintaining the compliance with standard, if the accounting is correct, it will help us to calculate, or it will help us to plan the tax, our tax compliances, or the tax planning. This will help client to make the informed tax planning decision making, maximizing benefits and the compliances. So fourth one is improve financial decision making. If we are following the IFRS, we are doing the transaction as per the standards. So that will give us the accurate financial statements, and accurate financial statement will help us to make the decision making, correct decision making. So that will help the business to make the strategy choices aligned with the financial goals also. Risk assessment. So identify risk at the base level. So if I'll go into scrutiny of accounts or at a transaction level, there if I can find the risk, what is the risk associated with that transaction if we are not following the IFRS, and we are going to correct that transaction at that level only, that to make the mitigation strategy and ensure the financial stability. So precise tax reporting. A regular accounting health checkup ensure precise tax reporting by identifying and rectifying error and inconsistency impromptly. So the practice minimize tax liabilities, avoid penalties, optimize tax related decision making for the purpose. So if I can say the base is the base of the tax planning or the tax reporting is the accurate that book profit. An accurate book profit arises when we'll do the transactions at a transactions level. If we'll follow all the IFRS standard, the transaction should be booked as per the standards. So that will give us the accurate financials reporting, and also that will give us the accurate accounting profit that will help us to plan for the tax and also the tax reporting, and also to calculate the tax. Last but not the least, building in trust. Building trust is a very important word for all the business organization. So building trust means investor, creditors, and other stakeholder gain confidence in the company's financial health when they see that regular checks are in place to ensure the transparency and accuracy. So that will also help the build the trust of the investors if we are following and if we are undergoing with the regular accounting health checkup at a transaction level. That will give confidence to the stakeholders, creditors about the financials, about the company's financials stability. So that is the some benefits that I try to cover here for with the regular accounting health checkup. If we'll go the regular accounting health checkup, this will give the benefit. This will actually to avoid the tax implications. That will help us to build trust of the investor, creditors, and outsiders. That will also help us to give the correct financial reporting that will help the management for the decision making purpose. Risk also, we can mitigate the risk at a transaction level also if we'll go with the under that deep or the thorough checkup of the transactions. So basically these all are the benefits that I try to cover here for the regular accounting health checkup. And as a crew, we also offer our clients to go for the accounting health checkup in lieu of whether the transaction has been recorded as per the IFRS or not, whether that's give all the disclosure are as per the IFRS or not. So we offer our clients also for the regular accounting health checkup in lieu of the corporate tax. So next slide I'm going to cover is the training sessions. So training session, what do you mean by training sessions? So being a professional, I always passionate about the professional development and the lifelong learning. So I'm excited to share fantastic training opportunities with you. Training opportunities or the course that we are going to start, and that crew is planning to start in a very short tenure of time. For why that accounting, and at what level that while doing the accounting, at what point that you should be in your mind, or the accounting should be as per the standards. So training is like investing in training in an investment in a future success. So that is the one that line that I just want to add here. So while training session, we need to see the client needs. So that as a crew, we are planning to start some training sessions, one-on-one training sessions or some courses. So we just want to understand the client needs. So accounting treatment will be different for the industry specific, as we have already discussed, and we have seen in previous slides of the IFRS 15 that revenue also recognized at a different stage for different industries. So different industries may have unique tax accounting requirement, and UAE has a specific tax regulations. So by conducting a thorough need assessment, we would like to know the specific need for the training and courses on an industry specific. So would like to know about the pain area and the accounting. So you can kindly drop me a mail to my mail ID for your pain area to help us to prepare the course material and the training sessions for you that will help you to do the proper accounting, that will help you that whether the accounting has been done as per the standard or not. So as per the specific client needs, we can prepare our course material or the training session we can conduct. So second one is develop a curriculum. So as I already discussed that every company and every industry has a different kind of accounting treatment for different the transactions. So develop a curriculum. So while getting your pain area of accounting, we can develop a customized curriculum for your specific needs on the basis of your specific needs and cover all the accounting requirements relevant for the corporate tax. Qualified instructor, yeah, instructor plays a very important role. If I'm talking about the training sessions and the course we are going to provide, so that qualified instructor plays a very important role in the success of the training program. So courses and training provided by the qualified instructor who are expert in the accounting in terms of the corporate tax, familiar with the UAE tax losses, tax regulations, and they must be having the good exposure in terms of the accounting treatment as per the IFRS. So customized training format, yeah. So training format will be as per the specific need of the industry. So we offer in-person workshops, we offer webinars, virtual classroom, online courses as per the client specific requirement. So course material will be like comprehensive training material we will provide you. Will provide you the textbooks, presentation, case studies, practice exercises, reference guide. This material should facilitate effective learning and the future references also. That will help you for the future reference. So interactive learning, promoting interactive learning by incorporating discussion. So we can have a one-on-one discussion, we can have a questionnaire session, we can conduct some case studies with you, we can share the case studies with you while during the training courses or the and encourage participants to prepare their knowledge, and you can ask as many as questions, you can discuss your pain areas during the training sessions and the courses. So will give you the outcome of this pain areas and will definitely help you to do the proper accounting as per the IFRS. So this is all about the training session. So I hope this webinar is quite interesting and hope you liked it. So now next one is like question and answer session, and while seeing the time, it's already 12 o'clock. So we are a little ahead of time. So please write your queries on another mail ID that I have given here. So we will get back to you with all your queries with the due time. Thank you so much.
Thank you so much. Thank you so much.
Thank you all. Thank you for your time for attending this webinar, and hopefully we'll come back with more and more detailed webinar about the IFRS. So it will be quite interesting with some example, with some questionnaire, with one-on-one discussion that will help you also to just understand why accounting is required at per the standard. So thank you so much.
Thank
We'll
you.
get back to your questions on a mail. Yeah, thank you.